Good morning, everybody, and welcome to our fifth episode in the No Webinar series. Today, I'm joined by four portfolio managers representing various asset classes within the Ashburton solution set. I'm joined by Davey on international equities, Lesiba Ledwaba on property, Daniel Masvosvere on equities, and Tlhoni Komako on fixed income. We're going to start off with the Ashburton Global Leaders Feeder Fund. The Global Leaders Feeder Fund has been a top or second quartile performer since inception in its respective CISA category. If I compare the Ashburton Fund to a well-known competitor that deploys a very similar philosophy and one of the largest in its respective sectors, the Ashburton Fund has outperformed this fund by a remarkable 5% over 1 year, 4% annualized over 2 years, and close to 2% annualized over 3 years. When comparing the Ashburton Global Leaders Fund to this competitor and the broader CISA category, which it has outperformed since inception, one of the conclusions, as per the graphic on your screen, that you can draw is how much more defensive this fund is during times of volatility. If you look at the next slide, you can see the drawdown graph at the top, and you can see how much more defensive the fund is relative to the CISA category. I'm going to hand over to Davey, who's a portfolio manager on the fund. Kathy is a portfolio manager and analyst for Ashburton's global equity strategies. She began her career as an equity research analyst covering pan-European retail stocks at Bear Stearns in the UK in 2007. In 2010, Kathy moved back to South Africa, where she joined Absa Barclays Capital to cover the South African listed retail sector. She joined Ashburton Investments in February 2013 as an equity research analyst and for African Equity Opportunities Fund, and moved over to the global equities team in 2018. Kathy holds a Bachelor of Commerce, IT and Accounting degree from the University of Witwatersrand, a Master's of Professional Accounting degree from the University of Southern Queensland, and is a CFA charter holder. Without further ado, I'm going to hand over to Kathy. Kathy, over to you.
Hi, Steve. Thanks for the introduction, and hello to all our listeners. So I thought I'd start off today just chatting around a few factors on why we should be positive on global equity markets this year. I'm going to start off just talking a little bit about the breadth of global equity markets at the moment, and the positive earnings growth we expect to see this year, a little bit around interest rates being likely to be directionally positive this year for global equities. We'll look at markets outside of the US that we don't think are that expensive, and then just touch on geopolitical tensions and quite a large year for elections this year. So let's start off by moving on to the breadth of the market breadth that we're currently seeing at the moment. So what this chart in front of you indicates is the amount of returns driven by the amount of the S&P 500 returns driven by the Magnificent Seven, which is the blue part of the bar. And as you can see, in 2022 and 2023, a disproportionately large portion of the S&P return was driven by the Magnificent Seven stocks. However, if you look at the year-to-date bar, we can see much more of a broadening out of the market, where the Magnificent Seven is less of a proportion of the driver of the positive returns that we've seen this year. And I mean, why is this positive? This is positive because it really indicates that investors are looking at opportunities across a wide range of stocks and not a concentrated few stocks. And that's really an indication of a healthy market. And it's specifically if you're running a portfolio, a diversified portfolio that invests across sectors and is not concentrated in one part of the market, which we do within Global Leaders portfolio. So just moving on to the next slide. So earnings growth. So let's look at the earnings growth of the S&P over the past few years. We can see that in 2020, it was negative, of course, because of COVID. We saw a massive rebound in earnings in 2021. However, if you look at 2022 and 2023, there was actually little to no growth in equity markets, and what we're starting to see come through in the first quarter of this year is we're starting to see positive earnings growth. So we're coming to the end of first quarter earnings, which have grown about 5 to 6%. But as you can see by the yellow bars on this chart, there's expected to be a growth, an acceleration in the growth as we go through the year, weighted towards the second half of the year. Now, why is this positive? It's positive because, in the absence of a derating of markets, investors do not necessarily need a big re-rating in equity markets in order to achieve a return from equities this year. Just moving on to the next slide. Let's talk a little bit about interest rates. So the chart on the left-hand side, and really what that is indicating, the red line is indicating, at the start of the year, the market expected interest rates to come down, well, for there to be about 7 rate cuts this year. That hasn't transpired. On the right-hand side, you can see CPI has come down, but it's been a bit stickier than expected. However, if you look at the blue line in the graph on the left-hand side, you can see that although new expectations are only for 2 to 3 rate cuts this year, the fact that we are expecting rate cuts rather than rate rises, it is directionally positive for equity markets. So when we see those rates coming through, this will be very supportive of growth within equity markets. And so, in this regard, we feel like we're going in the right direction. I mean, yesterday we saw CPI a surprise to the downside. So I think this is really just, getting the market a little bit more excited about the equity markets this year. Let's move on to the next chart. So just talking about opportunities outside of the US, if you're worried about valuations within the US, what this chart indicates, the red line is showing the average 5-year forward PE of regional markets across the world, and the dot is showing where these markets are trading at the moment. So on the left-hand side, you can see that the FTSE All World is trading fairly in line with its 5-year average. But if we break that down, the US is trading above its 5-year average PE, but Europe, the UK, emerging markets, and China are still currently trading below their 5-year PE, so there is opportunity there. I think really what stands out the most is China, and China's been a very difficult market to be invested in the past few years. The country really suffered from severe COVID lockdowns. Also, of course, we've had issues within the property sector within China, but we are starting to see green shoots. We've seen very supportive monetary policy coming through. We know that the government is pro-growth. And sentiment seems to be improving within this market. What we really need to see is that consumer confidence come back. Consumers have savings they can spend. They just need to be a little bit more confident in that market. But from a valuation perspective, this is certainly a market we're going to be, looking at adding to in terms of opportunities because of the valuations. So let's just, so I think the last point I'm just going to make on equity markets in general is that, yes, we've seen heightened geopolitical tensions this year. It's a big year for elections. There's likely to be volatility this year. We're long-term investors. We invest through the cycle, but volatility for us can often bring opportunities in terms of great quality companies we love, but are just a little bit too expensive in order to justify buying them. Sometimes volatility brings those companies into our acceptable valuations and allows us to pick up great stocks at decent prices. So from a stock picker's point of view, volatility can sometimes, be your friend. So just moving to the next slide. I wanted to give you an example of the types of stocks that we invest in the Global Leaders portfolio. It is a mega cap. It does have a mega cap strategy. So I wanted to pick a stock that was outside of these artificial intelligence related stocks that have done very well, and just talk about a few secular trends that we've seen outside of AI. So Eaton is a US industrials company. The company is an electricals business. It has made a fantastic job over the past few years transforming into a pure play electricals business, because basically the electrical space really feeds into great trends at the moment. So the energy transition, digital transformation, we'll go into a bit of detail about this. But really in doing that, the company has moved to a higher growth business, a higher margin business. It's got a very strong balance sheet. It's got good management. And as I've said, the capital allocation has been great. So let's just go into a few of the factors that are driving growth within Eaton. So moving to the next slide. The mega trends we're going to talk around are electrification, the energy transition, digitalization, infrastructure spending, reindustrialization, and Eaton has exposure to all of these mega trends across their key markets. So let's break a few of these trends down. Moving to the next slide. Let's talk about electrification. So at the moment, electricity is about 20% of the final energy consumption mix. However, that's expected to even possibly reach 50% of the global energy mix by the year 2050. Why? Of course, because we can generate electricity through renewable energy. So it's a great way for the world to decarbonize by using more electricity generated through renewable products or renewable energies. So moving to the next slide, what does that really mean for an electrical company? Well, it means there's going to be a lot of investment that goes into your traditional power grid. So, in the past, we had a power grid that had a power generation company on the one side, fueled by fossil fuels that generated electricity, which was eventually transmitted and distributed into residential or industrial areas. However, now, of course, that we add in renewable energies to the mix, we need much more connection points along the grid because, of course, we have to plug in solar energy where the sun shines and wind energy where the wind blows. And that means a lot more electrical investment into these grids. Second to that, renewable energies are actually, they're not as reliable as fossil fuels. And because of that, we need to instill the technology within these electrical grids to know at any time where the most reliable supply source is to meet the demand. Again, these digital solutions are products that Eaton supplies. So moving on, let's to the next slide. Let's have a look at reindustrialization and infrastructure spending. Amazingly, since January 2021, we've seen $1.2 trillion in US mega projects being announced. Looking at the chart on the left-hand side, you can see that's across sectors. So the semiconductor companies, batteries, EVs, commercial, institutional, there's a lot of investment that's going into these projects at the moment. And these projects have about a 3 to 5% electrical content, which is really supporting a great backlog for Eaton's electrical business going forward. And what's interesting is only about 16% of these projects have actually started. So, that really gives us confidence that Eaton's going to be very supported from a growth perspective moving forward. And lastly, these projects are supported by federal government incentives such as the Inflation Reduction Act, the Investment Infrastructure and Jobs Act, and the CHIPS Act. So we expect to see a lot of these eventualize and come through. Moving to the next slide, let's touch on the energy transition. We know that we are moving from internal combustion engine cars to battery electric vehicles. The electrical content in a battery electric car is 12 that of an internal combustion engine car. So really that's very supportive for an electrical business in terms of the manufacturing of these cars. But on the right-hand side, let's just talk about charging these cars. I mean, if you think of the office building that you're in at the moment, that office building was not originally built to take the charging capacity of 100 electric vehicles. So really a lot of buildings are going to have to be retrofitted to be able to improve their capacity to supply these charging to these electric vehicles. Again, another area that Eaton specializes in. The last secular trend, moving to the next slide, that I want to talk about is digitalization. So this is really where Eaton actually feeds into the artificial intelligence trend. Intelligence trend, because data center growth, as we know, has been very strong over the past few years. But of course, now with the excitement around AI, we know that we're going to have to develop these massive hyperscale artificial intelligence data centers. So we expect growth here to continue. Now, electrical companies are not only going to benefit, as we saw before, from these companies, building these data centers, but data centers are highly energy intensive. They use a lot of electricity. And so there's a great incentive for the manufacturers of these data centers or runners of these data centers to actually make sure that they are energy efficient. This is a big business for Eaton. It's about 14% of their revenue. Just out of a matter of interest, a great point is that the electrical demand for a ChatGPT search is 10 times that of a Google search. So there's going to be a lot of energy demand coming from these data centers, specifically related to artificial intelligence. And this is really going to benefit Eaton's strong portfolio within this space. So look, I'm just going to end off by giving you an indication of the performance of Eaton over the next slide. We did invest in this company over a few years ago when we recognized these secular trends coming through, and I think that gradually we've seen that the expectation be backed up by good earnings growth and good margins growth, and it's been rewarded for within the market. However, these trends will continue, and we will remain holders as long as the valuation makes sense for us. Look, I'm going to end there. Hand back to Steve. Thanks very much for listening to me.
Thank you, Kathy. That was incredibly insightful. You'll join us a little bit later on the panel discussion. Our next speaker is Lesiba. He manages the Ashburton Property Fund, which has had a stellar 6 months to the end of April, generating an eye-watering 21.7%. And over the past year to end April has outperformed the CISA category average for almost 2%. Lesiba manages the Ashburton Property Fund. He has over 19 years of industry experience and has been managing listed property portfolios over the past 10 years. He holds a BCom degree from the University of Witwatersrand and a certificate in property development and investments from UCT. Without further ado, Lesiba, over to you.
Morning, everyone, and thank you for joining this webcast. So I'm just going to take you through a few slides relating to the listed property asset class. As an icebreaker, the South African retail landscape is equivalent to about 23.3 million square meters in total. If you were to visualize it, I think if you are a Gauteng resident, just think of about 240 Mall of Africa type asset out there. So about 240 Mall of Africa equivalent SQM is the total of the South African retail landscape. And on this slide, I also just wanted to highlight that if we look forward, we'll see that we're expecting about 1.7 million square meters of retail space to come onto the market or to be constructed, which is not a hell of a lot if you compare that to history. It's equivalent to about 7% of existing retail real estate in South Africa. And the slow growth in construction, I think it's a factor of benign economic growth that we've been seeing, and the fact that interest rates have increased. We are going into a movie where interest rates are expected to remain higher for longer, and therefore inhibiting growth in a lot of interest rate sensitive sectors like real estate. Next slide, please. And on this slide, I just wanted to touch on a few events that have been the main reason for performance of the South African listed property market. Just wanted to focus more on the light blue square, which is the period where we experienced COVID-19. I think if we all rewind and just think back to those days where there was a lot of uncertainty as far as rentals are concerned. A lot of tenants, due to the fact that economic activity had stopped, were unable to pay rentals, which directly impacted performance of these shares. In fact, if you look at performance of the market during that period, from the peak at the end of 2019, all the way to the trough, share prices were lost about 50%. And in fact, for the entire 2020 period, the market lost about 34%. And recently, another impact, which was more localized, is the KZN floods. The impact on the market was not that severe because the market was a bit more diversified on a geographic basis. I mean, most of the exposure is actually in Gauteng. And ongoing geopolitics also impacting global economics. You'll see since the beginning of Russia's invasion of Ukraine, share prices have kind of been moving sideways. Next slide, please. And on this slide, I mean, as a listed property PM, one of the questions I get out there from investors as well as my colleagues is this the right time to buy? Because I sense a lot of investors have actually missed good share price performance that we have seen. So this slide was taken from one of the shares we have in our portfolio, which is Redefine, and I found quite interesting. So if we look at the real estate investment clock, I think at this point in time, the cycle has turned. We are actually, I think, closer to the number 7, where we are going into an economic environment where interest rates are expected to decline. And real estate, being an interest rate sensitive, I think will be a beneficiary. In fact, we have started to see a lot of the share prices starting to move in the right direction. I mean, if you look at performance over the past 6 months as well as a 12-month period, it has shown very good numbers. I'll highlight them to you in the next couple of slides. And I think part of the reason why this sector has done well recently, it's because it's largely under-owned. And if sentiment does turn, and given the low levels of liquidity of a lot of the stocks, I think if some money starts coming into the sector, it does tend to drive share prices quite meaningfully. So on this slide, I just wanted to show that if you look at a lot of multi-asset portfolios out there, positioning of investors is actually underweight to neutral. I mean, 48% of investors, according to the survey which was taken Jan or Feb 2024, were largely underweight. Only about 4% of investors were sitting with positions of neutral to overweight, and 12% overweight to the real estate sector. Next slide, please. I also think it's quite important to note that the reason why some investors are underweight the listed property sector is because they are seeking access to new and emerging sectors, sectors like data centers, self-storage. There's also healthcare as well, because the composition of the market has changed, especially if you look at US REITs. On the left-hand side, you will see that in 2000, the dominant sectors were retail, residential, as well as office. And composition has changed. You see that on the right-hand side, as at end of December 23, the largest exposure is actually to new and emerging segments of the market, which account for about 51%. So that segment of the market is exciting, and the drivers are quite good at the moment. Whereas in South Africa, for example, data centers are still at their infancy. In fact, I only know of a few projects that are ongoing where we're seeing a few data centers popping up in Gauteng as well as in the Western Cape. Next slide, please. Just to highlight how well the listed property market has done, you'll see on a one-year basis, the listed property index locally is up just over 13%. On a 6-month basis, up just under 24%. It's done well relative to bonds on a one-year basis, as well as relative to the broader equity market, which is up just over 1.1%. And to decompose returns, on the right-hand side, the gap between the black and the blue line is actually the income effect. The black line is the total return index or benchmark, and the blue line is if you look at performance of pure share prices. So I really think the income effect, I feel sometimes it's a bit underappreciated by investors. And if we go on to the next slide, if you look at history since 1999, you'll see that the red bars, which is basically income generated by SA REITs, has been consistent over time. Even during tough times like COVID, you look at 2020 where share prices were deeply negative, the sector was able to generate some level of income, or investors were able to get dividends, even though, as we all know, some counters were unable to pay dividends during that period. You go back to 2008, for example, there was some income coming through from the listed property segment of the market. So I think it just highlights that SA REITs or listed property market is suitable for investors that are looking for income in their portfolios. And again, I can also say for a more diversified portfolio, listed property still has a place in those type of portfolios. Next slide, please. And on this slide, just wanted to highlight some of the tailwinds and headwinds that are facing the sector. I'll start off with the tailwinds. I think fundamentally, there are some green shoots. We are seeing vacancies overall improving. If you look at, again, if you look at property values, they do appear to have stabilized, which is I think it's quite good. And if you look at turnover growth in a lot of the retail centers, even though retail sales growth has been benign, I think it's been satisfactory given the circumstance. And just given where some of these share prices are trading, I think we shouldn't rule out corporate action. In fact, we have seen, for example, Liberty 2 Degrees being unlisted. It was trading at a large discount to net asset value. And another important factor is we are likely at the peak of the interest rate cycle, which going forward, if we do see cuts coming through listed property, the fact that debt is a dominant feature of these shares, I think it'll benefit the sector. On the negative, however, what we are seeing over the next 12 months, for example, is this high cost of debt that we are coming through is likely to erode earnings. We'll see dividends coming under pressure. And I think the other issue that we all know of, geopolitics, could impact sector performance negatively if it doesn't play out well. So positioning within our portfolio, we still prefer exposure to non-urban retail. We do have some exposure to Central Eastern European retail. We also like alternative exposure like self-storage. Although office remains our least preferred sector, we are starting to see a bit of a turnaround in that sector vacancies also declining somewhat. Next slide, please. Now turning on to valuations. On this slide, you'll see that the listed property sector on a price to book basis is trading on a 0.68 times price to book. And you look at most of the counters that are exposed to the South African market. So you look at Growthpoint, Hyprop, as well as Redefine. They are all trading closer to 0.5 times price to book. One of the few counters that's trading closer to book is NEPI, which is trading at about 0.96 times price to book. So if we look at this chart, I think one question has to be asked, is it justified for some of these shares to be trading at half of their book value? Clearly, the market doesn't necessarily believe in valuations of their portfolios, but I do think there is some value in some of these counters. Next slide, please. Valuations or asset values have largely stabilized. In fact, if you look at the chart at the bottom of the slide, you'll see that since FY20, we've seen quite a lot of book values being written off. But recently, as companies release results, we're seeing some stability as well as some level of growth in book values, which is I think a positive sign overall. Next slide. Valuations again, but looking at it more from a yield perspective. If you compare listed property relative to the generic SA government 10-year bond, which is trading on a yield of closer to 12%, you'll see a sector at about 9.4%, Growthpoint, for example, trading at about 10.5%. I think looking at this slide, if you were to ask me listed property relative to bonds, I think on a risk-adjusted basis, my preference at the moment would be bonds in this case. But if you were to go back to November 23, for example, where the red line was trading above the light blue line, I think it was a definite indication that there is some value in the market where Growthpoint was trading at a yield higher than your risk-free at that point in time. And since then, we have seen some re-rating in these share prices, partly because we are heading into potentially rate reduction environment going forward. So they were just offering value or cheap at that point in time. Just turning on to, or just highlighting how fundamentals have improved. If you look at rental growth, for example, or rental renewal growth or reversions, they are moving in the right direction. You look at, for example, retail top left, you compare FY19-20 to recently released results, all pointing towards the right direction. On the top right, this is taken from MSCI. You'll see that basic rental growth also coming in at a positive 4.7%, just showing that fundamentals are turning the corner or starting to improve. The next slide focuses more on vacancies. You'll see that overall market vacancies, the left chart taken from MSCI at the end of December was looking at about 6.6%. And if you just look at the direction of those lines, you can all see they're pointing towards the right direction, a bit lower. Even office where vacancies are elevated is starting to move towards the right direction. On the right-hand side, just looking at the listed companies and the various sectors, you can see some level of improvement. Most notable is within the industrial sector, which is the bottom right chart. And next slide, looking at distribution growth outlook. We talked a bit about 2020, where you'll see the top right chart, where dividends during that period were down by about 29%. 2023, dividends were up about almost 3%. And for FY24, given the impact of higher funding costs, we're expecting dividends to come under pressure to decline by between 4 and 5%. However, as these high funding costs form part of the base going into 25, I think and if fundamentals continue to improve, we should be in an environment where we could start seeing some growth in distribution. So we're expecting closer to about a 4% increase in distributions in FY25. And the next slide, just highlighting how much base rates have increased, especially in the European space. I mean, if you go to, for example, 2022, 2022, the 3-month Euribor was trading closer to 0%. Of course, there are funding margins that are experienced by these companies if they get funding in the market. But you can see how much those interest rates have increased. At the moment, this 3-month Euribor is sitting at about 3.8%. So funding rates have increased from, call it 2 or 3%. Some of the companies are funding between 4 and 5%. So you can just imagine how much your cost of funding has increased and the impact overall on your earnings or distributions for a lot of these companies. For a lot of these companies, even locally, the 3-month JIBAR, which is the black line, and you can just see how much it has increased since 2022. The next slide, which will be my last slide, loan to values, which was a big topic in 2020. You'll see on this chart, loan to values were just above 40%. I think due to good management and effort by these companies to rein in on this measure, we've seen loan to values as well as stabilizing book values declining to closer to 40%. It is still a bit higher relative to history. I mean, the average is about 35% over this period, but it's not really a big issue going forward for the sector. So I think what I would like to leave you with is the fact that I think if you don't have exposure to the listed property segment of the market, I think you should start nibbling at this point in time. Yes, you have missed a little bit, but I think the tide is turning somewhat. Thanks a lot, and handing back to you, Steve.
Thank you, Lesiba. It's fantastic, very insightful. Apologies for what happened earlier. It actually kicks out. I think maybe Kathy jinxed in terms of the power grid and the amount of electricity that these are taking. Just noting, going to steer the 6 months to the end of April, generating an ROE between 21.7%. And over the past year to April's out, you can see the category average for almost 20%. And by 123 basis points annualized, that's 2 years. So comfortably beating the average of 1 year, 2 years, and 3 years, proving to be a consistent performer. So certainly a fund that our organization community are considering when investing clients' capital. Okay, so we pass now to a Q&A panel discussion, and joining me in addition to Steve and Kathy is Davey and Tlhoni. Your equity fund is a consistent top or second quartile performer, missing a top quartile rating over 3 years by mere 73 basis points. What were the 2 or 3 most significant changes you implemented to achieve such a remarkable turnaround?
Thanks, Steve. So, I mean, we've just been managing the fund now as the new team for just over 2 years. So actually, over the period we've managed the fund, it's actually into the first quartile now. The 3 things I'd sort of highlight. The first thing was obviously changing the team. So bringing in a team with an established track record in the active equity management space. Sort of moving the fund from a wealth management context to be more actively managed. The second thing that happened was the embedding of a proven bottom-up fundamental research process, which was also valuation-led. On the back of that process, we were able to focus the portfolio. So when we took over the fund, we had in excess of 100 counters in the fund, and we focused that, brought that down to circa 30 to 40 stocks, allowing us to deploy capital behind our best ideas, essentially. And so I think those are the key things that we've changed, and we hope to continue to compound positive returns over the medium to long term.
Okay, so coming to the fixed income side, we look at our Core Plus income fund. So this fund has done quite well in terms of both returns and growth. It was launched in September 2021. Just for background for those watching, this fund is before this we had the money market fund, which is a fund with only credit, with only bank paper, no credit. But then the maximum instrument tenor was 13 months, and then we had the stable income fund on the other hand, which is a fund that has credit and no limit in terms of the instrument tenor. So clients really needed that bridge between the 2 funds. So all we did with the Core Plus fund is get the best of both worlds. So we basically recreated the money market fund, but removed that 13-month maximum tenor limit. So now still bank paper, but we can invest in paper longer than the 13 months. Or you can look at it the other way. You say we recreated stable income, but without credit, still with no limit on the tenor. So as I say, the best of both worlds. The fund has delivered good results over the year. Current annualized effective yield is sitting at around 9.7, and I think that is quite attractive if you think about where rates are, with the narrative being high for longer. So and with inflation now to average around 5%, that means you're getting still a proper 4.7% real return for this fund. So how we achieved that? Yeah, it was basically the fund was really launched in a hiking cycle where we had the advantage of investing in paper already at a higher Java rate, whereas other funds would still wait for that 3-month lag for all instruments to reset. But also what helps this fund is that we invest or rather park some of the cash in our money market fund. So a money market fund, our money market fund is around 70 basis points above where you would get on call rates. So that also helps not have that big cash drag. So growth-wise, yeah, support has been great. It reached 5 billion in its first year, and yeah, hopefully in its second year anniversary now in September, we get to see it at 10 billion. It's sitting at 7.2 billion currently.
Kathy, let's bring you to the conversation here. Most of the hype has been around the Magnificent Seven. Do you see further upside in these shares, most notably after Nvidia's record-breaking rally 82% in a single quarter? And then which stocks are you currently invested in to generate alpha outside of these 7 stocks?
Okay, thanks, Steve. Look, when we look at the Magnificent Seven, as I said before, we were lucky to be invested in a few of them. But looking at companies like Google, Amazon, Nvidia, I mean, they're actually trading below their 5-year historic PEs. And this is really because the growth is still very robust in terms of what the market expects going forward. I mean, Nvidia in particular, yes, it was up about, over 200% last year, but they grew earnings by over 300%. So at the moment, these companies are really justifying their PEs. We know that artificial intelligence is still in its infancy. I mean, we really have to transition from general computing to accelerated computing now. That's going to be a lot of investment over the next few years. So we certainly, see this type of, maybe not to the extent that we saw over the past year, but we certainly see robust growth figures continuing for these companies. So, we will watch valuations, but for the moment we are still invested. So, I mean, in terms of outside of the Magnificent Seven, staying with the stock sector, a company we really like is Samsung. And the reason being is because, of course, we know the Samsung sells smartphones, but also another side of its business, it's the biggest memory chip producer in the world. Memory chips had a very difficult time last year. Memory prices were down quite a lot. There was a lot of destocking and a lot of channels. And this placed a lot of pressure on these companies' profits and also on Samsung. What we've seen this year is a restocking going on. We've seen much more support for memory pricing. This was confirmed on Nvidia's a recent Nvidia call when they were asked about what they're seeing in terms of commodity price inflation in their products. They mentioned that they are seeing higher memory prices, and this is really great time in the cycle for a company like Samsung. I mean, they also do feed into leading edge technology, but really we're getting quite positive on the memory space. Memory, again, the more technology that we use in our day-to-day lives, the more memory demand there is going to be. The latest iPhone, for instance, takes twice the amount of memory as the iPhone before. If we look at artificial intelligence demands a lot more memory too. So it's a great theme that we want to feed into. It is a bit more of a commoditized type chip, so you will get higher highs and lows. But over the longer term, we think it's a great theme to be invested in.
Okay, fantastic. And then just in terms of China. Many of the stocks have been rated. Do we hold any Chinese domestic companies, number one? And number two, just staying with China, the Chinese have purchased an incredible 118 tons of gold over the past year. So I would like to understand, and for the audience to understand, why China is so attracted to the Yadongis.
Okay, yeah. So in terms of China, I showed a chart earlier showing that the valuations they look very attractive at the moment. Of course, that hasn't been with it's not without risk. Sentiment still needs to improve quite a bit, and consumer sentiment. However, we are becoming incrementally more positive on the region, and from a valuation perspective, let's take Alibaba for instance, which is a company we are invested in. The reason we like it is because of the e-commerce side of the business. This company will benefit if we see a resurgence in consumer spending within China, but the company is also doing very well internationally in terms of its e-commerce building a business. The past few years have been difficult because of weaker demand in China, but also they have lost market share to other competitors. They've invested a lot in their platform, and we really expect to see some positive growth coming through there. But second to that, they are the largest cloud business within China, so they really have the opportunity to lead artificial intelligence there. If we compare a company, an e-commerce plus cloud business, to some of the US peers, where these US peers are trading on 20 to 30 times forward PEs, you're looking at Alibaba trading on single-digit PE. So from a valuation perspective, it looks very positive. So yeah, we're getting excited there again. Then just quickly on your point on gold. So the yellow, yes, of course. Yes, so you're right. I think the property sector has been weak, but not only that, the stock market has been a difficult place for retail investors to be. I think these investors are looking for opportunities outside of those areas, and that has benefited gold. It's obviously seen as a safe haven. But also a second point I'd like to mention is China's foreign exchange reserves. So China has about 3.2 trillion in foreign exchange reserves. They have slowly slowly over the past few years been reducing their reliance on US treasuries within their foreign exchange reserves. And this actually was accelerated when we saw the start of the Russia-Ukraine war, and even just a little, because they hold so many of these US treasuries, just a little shift coming out of that and into gold has been quite supportive for the gold price. So those are really the reasons why you're seeing the buying happening in China.
It seems the bond market is trading at an additional risk premium in light of the upcoming elections. Is your sense that much of this risk has been priced in, right?
Okay, sure. Thanks, Daniel. So there's definitely uncertainties in the bond market, but I think also a bit of election anxiety has eased a bit. So we look at the last poll as at 26th of April, where the results were a bit positive. We saw a removal of around 25 basis points be shaved off our own bonds relative to emerging market countries, rather. So maybe two things to consider about our bonds, especially now going to election. So the risk premium is still high. The bonds are still around maybe 100 basis points cheaper compared to fair value. And also they are around 40 basis points cheaper compared to other emerging market countries. So we have seen international investors and local investors still start pumping in cash back into the bond market. Before the 26th, year to 26th April, we were around 100 basis points cheaper on the 10-year. It was around 12.42, the 35s, and then today it's sitting around 12%. So we've seen a good 40-ish basis points really since then. So there's still a lot of uncertainty. I think the main question, or rather maybe to answer in short your question, is that risk is still priced into the bond yields. I think if we see the ANC get that around 40-ish percent or 45% votes in terms of the national votes, then that means that there will be a more smoother coalition process, which still gives us policy certainty. But yeah, the last part maybe to it is that what happens after this? That's the million-dollar question. What happens after post-election 6 months later down the line? That's where we should still focus. There's still political risk. We still have a bit of fiscal risk. NHI is in place now, and we also have Transnet issues. So the market should still see new reforms come to place and also the growth going forward.
Thanks so much, Tlhoni. Daniel, let's just bring you back into the mixture as well. The Fed's set to hold rates higher for longer. We started off the Fed saying they're going to probably start 8 rate cuts, into the system this year. Now looking at potentially 3. How are we positioning the equity portfolio in South Africa in light of what the Fed is considering?
Yeah, so we don't really run a top-down approach. I think it's very difficult to sort of macro forecast and run your fund on that basis. What we do, though, is I think we look at a range of possible outcomes and risk manage accordingly. So if you look at our portfolio, we're investing in counters really where the payback is not contingent on the macro. These companies do have within them, though, embedded a sort of natural hedge to a range of possible macro outcomes. So rate cuts is one consideration. The election here is another. But strong balance sheets, a diversification of the earnings and cash flow base is a key part of the investment thesis for a lot of the companies we're investing in. Which makes it so, in a range of macro outcomes, they still will be able to deliver a decent return and payback for us and for our investors. So that's part of how we're looking at it. The other point to highlight is there are within the SA context counters that do have call it a rand hedge sort of built in. So you think about companies like Richmond, most of their earnings are essentially XSA. NASPA's process earnings XSA are listed on the local bourse, though. So that we do have opportunities that are showing value, where we can deploy capital that also give us the ability to hedge some of the risk around the rand and the macro.
Fantastic, thank you. So to bring Lesiba. Please, the last 12 months has been incredible. SA listed property sector generated an output between 13.7%, which is unbelievable. Maybe you could allude to the factors that are driving incredible returns.
Thanks, Steve. I think if you look at 13.7% or so, it does look fantastic. But if you were to break down the return, you'll see that about 8 to 9% of that is due to the all-important income effect. And the rest, which is closer to 5%, is actually pure share price movement. I think what we have seen is a bit of an improvement in sentiments towards the factor, especially because we are going into some interest rate cutting environment. I think it's been a beneficiary of that, coupled with some improvement in fundamentals that have shown improvement in vacancies, rental growth, and so on. I think those have primarily been the drivers for the market. I mean, the return, most of it, we've seen it in November, December, as well as Jan. I think in November, the market was undoubtedly cheap. But beyond that, I think it's just looking forward and say we're expecting interest rates to come lower and fundamentals also expected to improve.
Thanks very much. Maybe what we should just do is bring Kathy back into the room, just with regards to Europe. I've read a couple of articles in terms of the EU and UK on a relative basis. Many pundits are saying that these markets are the most undervalued in 30 years. I know they've been phoned, so it's not ever been advice, but from a bottom-up perspective, surely there are some gems you can capitalize on over the next 12 to 36 months, Gabby.
Yes, thanks, Steve. So just looking back at the chart that I was showing before, even on a 5-year historical basis, the UK and Europe are still trading below their 5-year average PEs. So just as a reminder, we invest in a mega cap global companies. So even if these companies are listed, let's say on the UK exchange, they'll often derive, a smaller proportion of their revenues directly from the UK because they'll be exposed to international markets. But nevertheless, we are seeing better valuations in this market at the moment when we compare, certain companies to their US peers. One such company that we have picked up more recently is Siemens. Now, Siemens very much benefits from a lot of the themes that I discussed earlier for Eaton in terms of electrification. But the company also has another side of its business, which is automation. So automation is becoming increasingly important in terms of manufacturing and supply chains. What we saw over the COVID period was severe disruptions in terms of the global supply chains. There were a lot of weaknesses exposed. There seems to be a lot of investment needed here. We've seen labor costs go up quite substantially. We've seen labor shortages. The world is moving from globalization to regionalization. And also for manufacturers just to compete these days, they have to employ more automation and technology within their factories to be competitive. So all of these factors are really pointing to more spending within the automation space in the future. Now, as I said, Eaton feeds quite nicely into this trend. But another thing about the company is it's done particularly well in terms of integrating automation software with their hardware business. Now, it's arguably done a much better job than their competitors. They started doing this very early on, and it really is paying off for the company. As I mentioned, from a valuation perspective, this company trades below its peers. So we think there is a possibility for a re-rating with the stock as the market does shift towards looking at markets like the UK and Europe more. But I think also, the final point I just wanted to make on a company like Samsung is I think, one of the reasons that it trades at a discount to its peers is largely because it has historically been quite a complicated conglomerate. It's done a lot in terms of simplifying its business structure now. There's more they can do. It'll be great to see them doing a little bit more in this stance, but certainly I don't believe the current discount is justified from a valuation perspective, especially because they feed into these fantastic themes of electrification and automation.
Thanks, Kathy. And then just to wrap it up, I don't know if the audience is aware, but there's 1.8 trillion in fixed deposits waiting to be deployed into the markets. And if investors could invest 100% of their capital into one of your funds, why would they be picking your particular fund? Let's start off with you, Daniel.
Yeah, so I think with our fund, I think the opportunity really is to invest behind a team that's got a proven track record, that's delivering, I think, what is a turnaround that's showing good momentum in performance. And the other point I just want to highlight about SA equities more broadly is that I think your best returns are often generated at the point of maximum pessimism. If you can buy behind conviction on the back of proper work and research, and that's really the opportunity we see with this fund. So I think SA equities have been oversold. We are at the point of maximum pessimism around the sentiment, and I think there's a few green shoots highlighting the potential for a significant turnaround in sentiment post-election. So I think it's a good place to invest. Okay,
makes sense. And then obviously, fixed income, Tlhoni, that's pretty useful, whether it be private. It's not difficult to see that fixed income generating real returns at the moment. But why else would investors place 100% of their capital into your fund?
Steve, I think especially in the medium term, where we're seeing that volatility is still a lot in the market. These, like the fund we mentioned earlier, Core Plus or even stable income, these funds still give you some capital protection and proper income throughout while you invested in them. So I think the main thing is that you still want to get that real returns. Some asset classes have been struggling and without taking that extra risk. So well protected, and you can sleep well at night and take it easy.
Okay, we're risk averse with the returns. Makes a lot of sense. Davey, why would you use to place 100% into your fund?
So first of all, it's always a good idea to invest in markets outside of your home market. You're going to gain exposure to other economies at different points of their cycle. You get access to sectors that you might not be getting in your home market. So it's just a great diversification for your portfolio. And then talking to global leaders in particular, I mean, this fund really invests in mega cap companies that have strong moats, strong balance sheets. We expect them to survive tough economic cycles. And over the longer term, we expect these companies to produce returns above their cost of capital. So, again, it's that sleep at night type portfolio where we believe that, in difficult times, we expect this portfolio to fall less than the market as a whole. So.
Okay, and then, your fund has, and sort of really has done remarkably well in terms of returns. But is that set to continue? But you invest to place 100% into your fund.
Thanks, Steve. I think this fund is suitable, especially for investors who are looking for income. I think at the moment, the fund generates a forward yield of just over 9.4%. And I think if you are also looking for an option of capital growth as well, especially because we are going into an environment where interest rates are likely going to decline. So I think the sector will be a beneficiary. And if we have a more favorable election outcome, we've talked about risk premium priced into bonds. If that declines, I think listed property will also be a beneficiary.
Okay, so I think, look, if you're fairly, set of arguments from all our portfolio managers, and I think the message, here is quite clear. I think the well-diversified portfolio that incorporates both local equities, offshore equities, property, and obviously fixed income is the way to generate good risk-adjusted return for investors. So I'd like to thank, first and foremost, the portfolio managers on the call today representing their various asset classes. And to you, the audience, thank you for spending the last hour and a couple of minutes with us. If you look at the QR code on the screen, I appreciate it. You can just take a snapshot of that and put out a questionnaire so we can get some valuable feedback from you. And once again, it's been an absolute privilege hosting you this morning, and we look forward to hosting you in the near future. Thank you. Have a fantastic day. Goodbye.